Welcome back to the Australian Fund Monitors Meet the Manager series. The L'Oreal Investment Fund invests in life settlements and looks to provide investors with stable and non-correlated returns, while generating cash flow from investments that allow the fund to be used as a fixed income alternative, as well as a portfolio diversifier. The fund has returned 16.59% per annum since inception in May 2013, with a maximum drawdown of just minus 4.9%. The fund is lowly and in some cases negatively correlated to most of the popular asset sectors. I'm joined today by Alex Lee, Director of Investor Relations at L'Oreal Advisors. Alex, thanks for joining me today.
Thanks for having me.
Alex, why should investors consider life settlements?
I think life settlements by itself is a very interesting asset class. If you look at its investment characteristics, it's got potentially the returns of equity, but with the stability of fixed income, and with the added benefit of it being mostly uncorrelated to what happens in the public markets in most times, right? I'll run some stats by you, and I'll use my own fund as the representative of the life settlement industry. So let's say if we take S&P 500 over the last 7 years or so, it would have been negative. It would have reported negative months in about 29 out of 90 months. I'm taking the whole time frame as the fund, right? ASX 200 would have reported 34 negative months out of 90 months, right? The life settlement funds like L'Oreal, like our fund, we reported 2 negative months out of that 90 months period. So the stability of returns is there, right? On average, each month in the S&P would, over that same period, would give you about 0.7 to 0.8% return, right? ASX 200 would have given you about 0.6% return. The L'Oreal fund over the same time period would have given you about 1.3% return, right? Now, we had some really good years at the beginning. So now the average is closer to about 0.7, 0.8, which is on par with S&P 500. So what we're effectively doing is we're giving somewhat equity-like returns, but with the stability of fixed income. And that's kind of due to the nature of life settlements. Now, if we dig a bit deeper and you take the time to understand why does it work as well as it does, it's life settlements are resold insurance policies. It is a form of financing that's extended to an individual that is backed by the individual's life policy, right? And the way it works is a life settlement investor would give a lump sum to the individual, usually a senior, will give a lump sum to the individual for their expenses, their cash flow, whatever. Will extend the amount. The life settlement investor will then commit to paying the premiums on that policy until the policy matures. Upon maturity of the policy, the death benefit, because the maturity would involve the insured passing away, the death benefit would then be used to pay for the lump sum and to pay for the premiums that were paid, and a return for the investor, right? On average, if a well-managed fund would give about 8 to 12% per annum on such an arrangement, right? And this works because it disrupts what the life insurance industry does. As a person gets older, they've been paying 30 years of premiums to the life insurance companies. As they get older, they would have some cash flow problems, maybe increased healthcare expenses, less income, right? They don't want to pay the insurance policy premiums anymore. And they only get the benefit only gets paid after they die. So they can't go, why do I want to have this policy anymore? So they will give up on that policy. Now, the insurance company has already made provisions to pay for the death benefit. If an insured person gives up on that policy, the insurance company keeps all of the profits. What we're doing here with life settlements is we're coming in the middle and ensuring that the insurance company pays the death benefit out and gives a better solution, a better outcome to the insured person. So we're effectively paying forward the benefit to the insured, and that's why it works, and that's why everyone's in a better off position, just because we're lending financial resources to seniors to have a better cash flow situation.
You gave some examples then of the negative correlation or low correlation to some equity markets. What a lot of people don't realise, and I mentioned in the introduction, is that it's that the asset sector is negatively correlated to some fixed interest markets. Do you think that this lower for longer interest rate environment we're seeing at the moment is going to persist?
Unfortunately, it is going to persist. It is and it all comes back to the banks, right? The banks make money by lending money at a higher rate and financing it with lower interest rates by paying out to depositors. Now and everything gets referenced to that rate, right? If a bank pays out 0.5% to depositors, everything else paid to in that market would be referenced to that 0.5, for example. And so for banks, at this point in time, they have multiple sources of funding. They can get money from depositors, they can get money from the government, they can get money from other banks. And right now, the whole world is printing lots of money. So there is a lot of money out there in this world, right? So they can always fund their business model, right? There's no reason why they want to pay anybody higher interest rates, because if I have to pay higher interest rates to this person, I'll go somewhere else because there's someone else who's willing to give me the money, right? Therefore, interest rates are going to be much lower for the foreseeable future. Interest rates will usually hike when economic activity picks up. There is growth, there is production. But we have just spent the last 6 to 9 months fighting a pandemic, and the fight's not over yet, right? The stimulus money, all of those money coming out, they are not actually productive money. They are money paid for us to fight the virus. No new chairs are being made. No new buildings are being built, like less of them. Those are not productive money. We're just being paid to sit at home.
Yep.
With that, governments will continue to open the taps, provide free money to the banks, and as long as the banks do not have to go out anywhere else to look for funding, they will keep deposit rates low.
I think that's a really strong point. And while L'Oreal is relatively new to Australian investors, you've operated overseas for quite a long time. Tell me, what do you think Australian investors can learn from some of the family offices, both in Europe and Asia, who have been dealing with this lower for longer style interest rate environment for the last couple of years?
It's interesting you say that. I mean, I spent quite a bit of my career outside of Australia, and we have been, and other economies have been in this environment for a much longer period of time. So it was very interesting to see the reactions or the how they have reacted to this environment. There's two things that kind of really pops up to mind with the ones that are more sophisticated in terms of their way of thinking. So if you take a family office and you what's the first thing they did was they put on a new lens in terms of how they would look at their asset allocation. They thought about, okay, we've got an equity and bond type of portfolio. Why do we have this kind of mix? And then they'll realize, okay, equity is for growth. You want your assets to go to the moon. And your bond portfolio is really for stability of returns. That's your stable type of income. And traditionally, you go, if I put my money in the bank, that's stable, right? And that's the thinking that they usually have. But once they were in this environment where interest rates were lower, they re-looked at what it meant to have this fixed income portfolio. What do they do with this fixed income portfolio? And then they realized we could actually mess around with it and take a step back. As long as we look for stability of returns that are uncorrelated to the market, that's our fixed income portfolio. That enables us to take risk on the growth side. So we have to take care of the fixed income side, and then we can take risk on the growth side. So that was one of the lessons that they had. And the second takeaway, and that was that lens, right? The second takeaway was that what did they then do? One of the strategies that came out was if banks are only going to pay us so little interest rates because it's an expense item for them, what if, and we have the capital, what if we stepped into the role of the bank and provide financing, and we earn what the bank earns on their revenue line? We might, the families might not have the expertise, so they'll hire managers to kind of run that for them. So, and that becomes the genesis of quite a number of kind of fixed income alternative funds, if you like. So you have guys who will do property debt, who are good at managing property debt. You have guys who are good at financing SMEs. You've got trade finance people. You've got guys who more specialized guys who will do regulatory capital kind of management. So all of those funds came up. L'Oreal was one of those funds that came out from that, because L'Oreal was started up by a bunch of rich individuals who wanted to do this and identified life settlements as the area they want to get to, hired some industry veterans, and off they went. Right, this was done 7 years ago.
Yeah, it's a very good point. I think a lot of Australians don't have a lot of experience with life settlements, but I think many do understand that looking for uncorrelated assets is important, particularly reduce sequencing risk, and really the last 9 to 12 months has shown us that. Alex, thank you so much for your time today. Thanks for joining me.
Thank you.